There is a mix of tax outcomes that could cost a senior homeowner $75,000 when they sell a house they have owned for many years. Not because they did anything dishonest, not because they concealed anything, but because of one simple family choice most people have never even heard about. I know a woman in Ohio who learned this the difficult way. She owned her home for 34 years. She sold it last year, expecting to owe zero in taxes. She had lived there her entire adult life, raised her children there, paid it off long ago. A straightforward sale, a new beginning. She owed $23,400. And the choice that led to it, she made at her kitchen table on a Tuesday afternoon, believing she was doing the right thing, believing she was protecting her family. It took her less than 10 minutes. If you are over 60 and you own a home, April 15th is the date that decides whether you can address this quietly or handle it the difficult way. And I mean that exactly as seriously as it sounds. I am going to explain exactly what she did and why it matters for you right now. But before I go into it, a quick note. Everything I cover today is based on current IRS guidelines and federal tax law, including the One Big Beautiful Bill Act signed into law July 4th, 2025. Nothing in this video replaces advice from a licensed tax professional. Use it as a starting point, not a final answer. Here is what this video covers. 4 traps. 4 completely normal homeowner choices that are quietly creating IRS issues for seniors right now. Then 3 things that could actually put money back in your pocket on your 2025 return that most people over 60 have never heard of. Then a 7-step action checklist, including a free tool on the IRS website that shows you exactly what data they already have on your property. Most people only discover the traps. Very few learn about the money they are leaving behind. By the end of this video, you will understand both. Do not leave early. The 4 traps spell one word, home. H is for home equity mistakes. O is for ownership and deed changes. M is for move-out timing before a sale. E is for extra income from the home. Before we continue, if this is helpful today, please hit the like button and share this with anyone in your life who is over 60 and owns a home. That one share could save someone thousands of dollars. The people who need this most are often the last to see it. Now let me complete her story. Her name is Margaret. She is a fictional composite based on real situations tax professionals encounter regularly. Every person I mention in this video is the same. Real outcomes, composite characters. Margaret's husband passed away a few years ago. Her daughter Sarah stepped in after that. Groceries, repairs, doctor visits, everything. One afternoon, Margaret's neighbor mentioned that adding Sarah to the deed would make things easier later. Avoid probate. Keep the home in the family. It sounded logical. So Margaret did it. County Recorder's Office. Simple form. No attorney, no tax professional, no reason to question it. Here is what nobody told Margaret. When you transfer partial ownership of your home to another person, even your own child, the IRS may treat that as a taxable gift. Depending on the value transferred, that may create a reporting requirement on Form 709. And when the home is eventually sold, the person you added to the deed may not qualify for the same tax exclusion you do because they never lived there as their primary residence. Margaret found out 2 years later when her tax preparer reviewed her return and said 4 words she was not prepared to hear. We need to talk. Every dollar of that bill could have been avoided. The IRS does not consider why you did something. It looks only at what you did and whether it was reported correctly. Good intentions do not appear anywhere on a tax return. So let's get into the H home equity mistakes. Stay with me because this is where most people lose focus. And that loss of focus is exactly what costs them money. Most homeowners believe that if money came from their house, it must be tied to the house for tax purposes. That assumption is incorrect. A senior borrows $40,000 or $50,000 against their home through a HELOC. They use it to help a grandchild with college, handle a medical emergency, or pay off debt. And because it came from the house, they assume the interest is deductible. It is not unless the funds were used to buy, build, or significantly improve the home securing the loan. That is the rule under the Tax Cuts and Jobs Act of 2017. If the money went elsewhere, That interest is considered personal interest, not deductible, and claiming it incorrectly creates a mismatch that the IRS automated systems are increasingly effective at detecting. Think back now. Did you take out a home equity loan or open a HELOC in the last 3 years? Where did that money actually go? Into the house or somewhere else? If it went somewhere else, you need a conversation with a CPA or enrolled agent before April 15th, because if that interest was handled incorrectly, there are steps available now that become much more difficult after the deadline passes. And the O trap is the one that creates the most disagreement when I explain it, because people hear it and immediately say that cannot be correct. That is just a family choice. I hear that every time, and every time I respond the same way. That is exactly why it is so risky. A senior adds an adult child to the deed for estate planning, probate avoidance, or simply because that child has been helping and it feels right. What feels like a family decision is also a tax decision, and those two things do not always align. Think about the last 5 years now. Has anyone's name been added to your property? A child? A grandchild? Anyone? If yes, and no gift tax return was filed that year, keep listening, because this next part is specifically for you. When you add someone to your deed without them paying fair market value, the IRS can classify that as a taxable gift. When the value transferred exceeds the annual exclusion limit, a Form 709 gift tax return is generally required depending on the structure of the transfer and your specific situation. If that was never filed, that is a reporting gap sitting quietly in your history. And when you eventually sell, the person you added to the deed may not qualify for the primary residence exclusion, the rule that allows most homeowners to exclude up to $250,000 in capital gains, or $500,000 for married couples because they never lived there. Their share of the gain may be fully taxable. A sale that should have been tax-free becomes partially taxable because of a deed change that took 10 minutes. I have spoken with seniors who learned about this at the closing table, not before the sale, not during the listing, at the closing table. Papers already in front of them. That is when they heard it. There is also the basis issue. If you transferred the home entirely as a gift rather than leaving it as an inheritance, the recipient receives your original purchase price as their cost basis, not today's value. If you paid $80,000 and the home is worth $380,000 today, they could owe capital gains tax on $300,000 when they sell. Had they inherited it instead, the basis would reset to current market value, and that gain would largely disappear for tax purposes. One path costs the family nothing. The other costs them tens of thousands. The only difference is the timing of the transfer. Now that is why April 15th matters more than most people realize. The IRS has an automated system called the Automated Underreporter Program. It compares your tax return against third-party data. Mortgage servicers, rental platforms issuing 1099-K forms, and property-related records. The gap between what you report and what the IRS can see has been shrinking for years. Tax professionals are seeing more automated notices and more matching discrepancies than at any point in recent memory. After April 15th, if something has not been addressed, interest begins accruing automatically. Penalties increase. And the first-time penalty abatement program, a real IRS policy that allows taxpayers with a clean compliance history to request reduction or removal of certain penalties, becomes harder to use once assessments are finalized. The earlier you act, the more options you have. Now the move-out timing. This is the one that affects seniors the most, and it is the most misunderstood rule in residential tax law. Under IRS Section 121, to exclude up to $250,000 in capital gains from your home sale, $500,000 if married filing jointly, you must have lived in the home as your primary residence for at least 2 of the 5 years immediately before the sale. That is the 2 out of 5 rule. Here is where it quietly impacts people. Let me show you exactly how this happens. And as I explain this example, I want you to picture your own home, your own address, and think about where you have lived for the last 3 to 5 years. You move in with your adult children because of a health issue or into a smaller place while your home sits on the market, or you start renting it out while waiting to sell. All of these are reasonable decisions. All of them affect your residency calculation. Say you moved in with your daughter in January 2021. You kept the home, tried to sell, could not get the price, rented it for a year, and finally sold in March 2026. You moved out January 2021, sale closed March 2026. That is more than 5 years since you last lived there. Under the 2 out of 5 rule, you may not qualify for the exclusion at all because both qualifying years fall outside the 5-year look-back period. If the home gained $200,000, you could owe capital gains tax on the full amount. For many homeowners in this range, that is roughly $30,000. Not because you did anything wrong, but because retirement circumstances and a tax timing rule overlapped in a way nobody explained. There are partial exclusion provisions under Section 121 for health-related moves. They are real, but they require documentation and do not apply automatically. And here is something important because Dorothy's story shows exactly what happens when this trap combines with the next one. If you have moved out of a home you still own and plan to sell, count the months this week. The window to address this exists right now. And now the extra income from the home. This is the one people dismiss first because the amount seems small. That dismissal is exactly what makes it costly. A senior rents out a spare room, maybe through a short-term rental platform, maybe to a college student, maybe a family member pays something modest to stay in the basement apartment. It covers utilities. It feels practical. But the moment your home generates rental income, any amount, any arrangement, the IRS treats that portion differently. 3 things change. First, that income must be reported on Schedule E. Informal arrangements are not exempt. No formal lease does not mean nothing to report. Second, a portion of your home expenses may become deductible against that rental income, but without documentation, you either risk issues or you overpay. Third, if you later sell the house, the rental portion may not qualify for the primary residence exclusion. The gain is divided between residential and rental portions. The rental portion can be taxed as a capital gain. And depreciation recapture under Section 1250, taxed up to 25%, can apply to the rental portion even if you never claim depreciation. That spare room rented for $600 a month for 2 years can affect the tax treatment of your entire home sale. Not just that room, the entire transaction. Now, Dorothy is 68, Tennessee, lived in her home for 27 years. In 2022, a health issue led her to move in with her son, Michael. Temporary. She told herself to cover expenses while waiting to sell. She rented the house to a young couple, about $1,000 a month. She did not report it the first year because her accountant had retired, and the software she used did not prompt the right questions. The following year, Michael added his name to the deed just in case Dorothy's health declined. No gift tax return filed. Early 2025, Dorothy sells. 27 years of ownership. She walked into closing expecting a clean, mostly tax-free sale. The IRS determined she had moved out more than 2 years before the sale. The rental period changed part of the home's classification. The deed change created a reporting gap. The unreported rental income was another issue beneath all of that. Dorothy owed $23,400 across 3 separate issues, none of which she knew existed when she made the decisions that caused them. She was not careless. She was not hiding anything. She was a 68-year-old woman handling a health issue, a housing change, and a family situation at the same time without anyone explaining what she needed to know. Dorothy did not fail the system. The system failed Dorothy. But the system does not adjust based on that. That is why this video exists. I want you to pause on that because what comes next is different from everything so far, and most people watching will wish they had known it sooner. Now, the other side of this, because everything so far has been about problems, the next few minutes are about money you may be leaving unclaimed right now. Real money confirmed by the IRS available on your 2025 return. The first is new, and many preparers are not flagging it automatically. It is called the Senior Bonus Deduction, and it is part of the One Big Beautiful Bill Act signed July 4th, 2025. If you are 65 or older, you can claim an additional $6,000 deduction on top of what you already deduct. Whether you itemize or take the standard deduction, it stacks on both. Married with both spouses, 65 or older, that is $12,000 total. available for tax years 2025 through 2028. Phases out starting at $75,000 modified adjusted gross income for single filers and $150,000 for joint filers. For many seniors, where 50 to 85% of Social Security is taxable, this deduction lowers taxable income enough to reduce that exposure. It will not eliminate taxation entirely, but it can reduce it meaningfully. For many seniors, that is $1,000 to $2,500 in real savings. This provision was hidden in a large bill. Some tax software has not been updated. Some preparers have not caught up. Ask your preparer directly, did you apply the senior bonus deduction from the One Big Beautiful Bill? If they seem unsure, consider getting a second opinion.